Required, evaluate whether the recommended tactical asset allocation is feasible. Number 2, appraise the logic of the recommendation. So we are saying that in trying to answer those two questions, we are being told to analyze whether William, being a chief investment officer, has tactical ranges that lie within the IPS. So the IPS is the foremost, or is the yardstick that we should be able to focus on when trying to develop tactical asset allocation ranges. So the IPS, we are seeing from the question, the IPS authorizes tactical ranges of plus minus 10%. So what does that mean? So you can come on this other side over here. So if we have plus minus 10%, and the initial asset allocation was 45%, 15% in non-US developed markets, and 40%. So we are saying we are going to move this plus minus 10%, this plus minus 10%. So of course, 10% of this is 4.5. So that means it's going to be this plus 10%. So plus 10% is going to go to 55. Sorry, not 4.5. So it's going to go to 55. So it can be able to go to maximum. The lower limit can be 35 to 55 for that asset class there. That's what I'm saying in terms of percentages there, plus minus 10%. Plus minus 10%, it can go down to 5% to 25%. Here, it can go to as low as 30% to 50%. So that is the area we are talking about. Now, the current asset allocation now is 55 over here, based on what William is actually stating. It's gone down to 5% for this other asset class and 40%. Yeah. As you can see, this is the previous asset allocation, 45% in US equities, 15% in non-developed market equities, and 40% in US treasury inflation protected securities. So tips. So we are within the range as specified by the IPS, which is right over there. So we can be able to conclude in trying to answer part 1 over there that when we're told to evaluate whether the recommended tactical asset allocation is feasible, we can say that Williams' asset allocation, tactical asset allocation, is within the tactical ranges allowed by the endowment based on IPS. The second part of the question is asking us to appraise the logic of the recommendation. So we are saying it's based on the skill set that William actually thinks about. And we are saying that if William believes that those allocations are correct, then the decrease in the treasury notes like that should actually constitute towards generating a return that is going to maximize the portfolio return by extension. So we're also saying that William also expects that the US market is going to outperform. So he decides to increase the allocation from here to over here. Here is expected to remain the same like that. So the allocation over here was towards the US TIPS, Treasury Inflation Protected Securities. Here the allocation was towards non-developed markets. So non-US developed markets like that. And over here is, of course, we are saying is the US equities, US.